Hey, Jim,
Yes, sir.
I'm going to go ahead and make you host, okay?
All right, hold on. I'm trying to find out how to get the video to work. All right, now I think we're there. Okay.
All right.
Are you going to do an intro or what?
Yeah, just give me one. Get my side up here. Okay. All right, guys. So we're slowly rolling in here. Got quite a few on so far. So what I'm going to do, I'm going to kind of launch a little intro here and hand it off to Jim so he can get started. It's about 11:03. So but for those who don't know, Jim is the founder and president of Anchor Tax Relief. He's actually helped prepare over 1,000 realtor tax returns over his time in the space, and is actually a former real estate agent himself. So, I'm pretty excited for what he's about to bring to you guys and talk to you guys about, just seeing it more so from our perspective as an agent, and being able to, hopefully keep more money in your pocket, and overpaying and things like that. So Jim is pretty well known here in the Hampton Roads area, here in this space. So I think you guys are going to get a lot out of it today. And yeah, so I am also going to, Jim, if it's okay with you, I'm going to go ahead and record this to our cloud library. Is that okay?
Absolutely.
Okay, great. So let me turn this on, and then what I'll do is, just for those who aren't able to make it, then I will switch it over to you. So so with that being said, Jim, I will turn this over and have you get started for us. Thanks again for doing this, Jim.
Absolutely. Thank you, Matt. I appreciate the opportunity. Good morning, everybody. I know you're all working hard to make money in real estate. And so let's talk a little bit about how to keep some more of that money in your pocket and share less with the IRS. You sure work hard enough for it. So we want to talk about every legal means, every legal strategy, tactic, deduction, credit available. My philosophy is owe to Caesar, what is Caesar's, but not a penny more. So what I want to do is I want to see if I can find, and I can't automatically, but I'm sure we go. Okay. I am going to be sharing a PowerPoint here. And so let's get started. So if I can move this guy over here and hit share, no, hitting all the wrong buttons, slideshow. Okay. Can everybody see this? Okay. I'm gonna have to assume yes, because I don't hear any voices and it looks like
I can I can, we can see it fine here, Jim.
Okay, cool. I want to talk about the top 10 tax mistakes that real estate agents make. And any one of these mistakes can cost you thousands. So there's a lot here. And we're going to go through this rapidly. If you'd like to grab a copy of this presentation, you can see there's a bit.ly link here, bit.ly/realtors tax secrets. And you can access, just put in your email, you can access a copy of this thing for yourself. Matt introduced me, Jim Flouse, last name rhymes with house. If you sell houses, I can help you save taxes. So there's 10 mistakes, and I'm going to have to learn how to move this. Okay, definitely. All right. First mistake that realtors make is just simply failing to plan. I remember, well, let me just put it to you this way. It doesn't matter how good your current CPA, your tax preparer is with all the paperwork that you provide him or her on April 1st. Doesn't matter how good they are with that. If you didn't know, for example, that you could deduct your child's braces and deduct them on your business return as a business expense, and then make plans accordingly to implement that plan, Section 105, mid-year through 2022, then it won't matter how good in April of 23 your tax guy or gal is, because it's too late. You didn't plan. And I remember that this year, especially on Instagram, on TikTok, there were a ton of business owners complaining about their taxes this was on April 19th. The filing deadline, I think, was the 18th this year. On the 19th, just all kinds of wailing and gnashing of teeth about how they were going to find a new accountant and how their CPA didn't do them good and they need to find a better preparer. Trust me, if you just do this thing the same way, you get a new preparer, you get a new CPA, but you don't change the way you're doing things during the year, it won't make any difference. They'll just bring you the same results, which are reactive, right? There's two ways to do taxes. Reactive, meaning you send your tax stuff to your tax preparer after the year is over, and then they do their best job to write down last year's numbers on last year's forms, and then they call you with the bottom line. That's all reactive. It's all after the fact. You need to be proactive. So there's nothing wrong with a strategy to avoid paying taxes. The IRS code doesn't prevent that. In fact, it encourages you. A Supreme Court justice here is encouraging you to be proactive. So we'll talk about how that's done. Now, first, let me just take a step back. Let's talk about how the tax code works from like a 10,000 foot level, not trying to give you an education on taxes or make you a tax geek. You just need to have some general knowledge to know what is taxed. So basically, I can't get this thing to operate well. Okay. Basically, everything that you bring in is taxable. Your earned income, your business income from your real estate, any interest and dividends you get from banks or investment firms, capital gains you might have on the sale of a flip, pension money, IRA distributions, alimony that you might take in, gambling winnings, even illegal income. Okay. You can have a second job as a bookie or selling herbal supplements. Just have to report that on the tax return. You can also deduct the costs that are associated with those income items. After you take all of the income, then the IRS gives you something called adjustments. Now, these are like deductions. These bring your taxable income down. IRA contributions used to be moving expenses. This doesn't exist anymore. Half of your self-employment tax, self-employment health insurance, self-employed retirement contributions, any alimony you pay out, any student loan interest you pay out. These all bring down your taxable income. Then against that, you apply either a standard deduction or an itemized deduction. Now, it used to be a lot of people itemized their deductions. And by itemized, I'm not talking about your real estate expenses. I'm not talking about advertising and dues and memberships and business meals and auto expenses. Not talking about that. I'm talking about itemizing things like your real estate mortgage interest, your property taxes, your church contributions, your medical expenses. Those potentially could be itemized. But in reality today, fewer than 10% of people actually itemize. Most take the standard deduction, which if you're single is $12,550. If you're married, the standard deduction is $25,100. Either that or you can itemize. And I just went through the itemized. Now, what tax bracket are you in? Before you even look at this chart, I just want you to, in your mind, I want you to ask yourself, what do you think is your federal tax bracket? Is it 10%? Is it 20%? Is it 30%? When I present this at a real estate office and I am in front of a bunch of agents, I get answers everywhere from 10 to 37%. But look at these numbers. Let's say you're single and your income is 50 grand. What is your taxable rate? You're going to be taxed 22 cents on every dollar you make. What if you're married and you make 80 grand? Let's take a little higher. Let's say you're married, you make 100 grand. Same thing. You're in the 22% tax bracket, and it just goes up. So in other words, our tax system is a bracketed system. You will pay 0% on the first $99.50 that you earn. You pay 12% on the next between 9 and 40,000, and so on and so forth. So the brackets go up as your income goes up. The reason I want to bring this to your attention is just kind of hold on to that 22% number for a minute, and we'll get back to it because it's really not going to be what it appears to be. Okay, you can take some tax credits. There's education credits, child tax credits, foreign tax credits. Those come off. Then at the end of the day, and there's self-employment tax, by the way. Then at the end of the day, there's going to be this taxable income number. How do we lower that taxable income number? There's three ways, kind of big picture wise, three strategies you can use to cut your taxes. One is called a timing strategy. Now, what does that mean? What that means is imagine you make 150 grand this year selling real estate, but you can push the timing on 50 grand of it to some future year. In other words, you make 150, you push 50 grand to some future tax year, so you only get taxed on 100. That's a timing strategy. Or there's something called a shifting strategy. So imagine this. Imagine you make income, but you shift 10 or 15,000 of that income to your child or your grandchild. Now, why would you do that? Well, typically children are in a much lower tax bracket than you are. So it's called a shifting strategy. And finally, there's code-based strategies. Code-based strategies are real simple. You know what the code is, you maximize your deductions. So you know about office and home, you know about business meals, you know about auto deductions, you know the code. You're not really expected to know the code as much as I am, but just have a general idea of it. This is where most realtors, frankly, focus as they talk about, I need more deductions. Well, you do need more deductions. You do need to know how to use the code in your favor. But in addition to the deductions, you need to use some timing and some shifting strategies. And finally, there's something called product-based strategies. I don't sell product. I'm not in the tax shelter business or the insurance or investment business. So we're not going to talk about that today. We are going to talk about the other three. So let's take a step back. What are we talking about? We're talking about the top 10 mistakes agents make that cost them thousands on their taxes. The first mistake is just a failure to plan, a failure to kind of know the overall tax picture and then how to plan to reduce your taxes and work with a tax professional to plan and proactively manage your taxes. That's mistake number one. Mistake number two is just audit paranoia. Let me give you an example of what I mean by that. It's okay to respect the IRS. It's not okay to be so afraid of the IRS that you don't take legitimate deductions. I'll give you an example. I have a lot of people who come to me and I'll look at their last year's tax return and they're in real estate, right? And I'll see, like a $2,000 auto deduction. I said, how'd you come up with this? Well, I drove about 4,000 miles. I said, really? You really only drove 4,000 miles when the average American drives about 10 to 12,000 miles and you're in real estate? What's your mileage log say? Well, I didn't keep a mileage log. So I was really just trying, I didn't want to, kick up any dust with the IRS. So I just was conservative and I just claimed 4,000 miles. That's audit paranoia. And that's not even reasonable that you would only drive 4,000 miles if you're a full-time agent. But you're so afraid of the IRS, you're not taking legitimate deductions. The fact of the matter is audits are at an all-time low, okay, have been since about 2015. The IRS just doesn't have the personnel. They don't have the budget to audit a lot of people right now. I'm not saying you should run afoul of the IRS or run afoul of the rules. I'm just saying you shouldn't use your fear of an audit to not claim legitimate deductions. The reality is most of the audits are in cash-oriented businesses like laundromats, convenience stores, gas stations where there's a lot of cash changing hands. That's really where the IRS goes first. The third mistake agents make, and this is probably the biggest one, is having the wrong business entity. Now, what do I mean by that? You can see several types of legal entity structures listed on the screen. C corporation, S corporation, partnership, sole proprietorship. You may notice LLC isn't even on the screen. I'll explain why in a minute. But how many of you, I can't really do it by a show of hands, I guess, but when I speak live, I ask agents in the room, how are they structured? And about 20% will say corporation, about 20% will say LLC, and the other 60 to 80% don't even vote because they don't know. The reality is this can make a huge difference in your taxes. Usually when you go into business, just by default, if you don't make a formal step to set up some type of entity structure, you are by default a sole proprietorship. In fact, if you drive up and down the streets in Virginia Beach, Chesapeake, Norfolk today, 80% of those businesses are sole proprietors.
Hey, Jim, don't want to cut you off. Dr. Mary's trying to get back into the meeting. Do you see, because I made you host, do you see somebody trying to get in?
Okay, I'm going to admit Dr. Mary and Jinky.
Yep, there you go. I appreciate it. Thank you.
Okay, thanks for the heads up.
All right.
So let's talk about how a sole proprietorship is taxed, since most of you are this way. You report your income on what's called Schedule C. In other words, you don't have a separate business tax return. It's just a Schedule C on your Form 1040. You put your net income there. What do I mean by net income? Okay, if you have a $100,000 GCI from Swell Realty this year, and you've got 20,000 in expenses between auto and advertising and lead generation and dues and memberships and office supplies and so on, your net income is 80. Okay, so it's not your top line gross commission, it's your net income after expenses. That goes on your Schedule C. That's taxed at the 22%. Remember that number? Turn off my cell phone here. Okay, but there's one other way you're taxed, and that is you also pay something called self-employment tax. Now, this is not income tax, but it is something you pay when you file your 1040 income tax return. Self-employment tax is Social Security and Medicare. No one's taking this out of your commission checks, but the IRS expects you to pay it. It's 15.3% of your net income. So let's go back to that 80,000 example. If you have 80,000 of taxable income from your real estate sales business, and 22% of that is taxed as income tax, and you add 15% of that as self-employment tax, aren't you really in a 37% tax bracket? Yeah, 37 cents on every dollar you make. Oh, and don't forget, you live in Virginia, that's another 5%. So we're really talking about 42%. And this is why, I beat the table and say, look, taxes are the biggest expense in your real estate business. I know you spend a ton on automotive and on advertising, but the reality is you're spending 42% in most cases on taxes. It's the number one expense in your business. Here's a way to fix this. And by the way, it's called a S corporation. So an S corporation is simply a family-like based business. I mean, most realtors today are S corporations. Some are C corps, but let's just go with this for a minute. S corporations allow you to split your income. So let's take that $80,000, that is your net, and let's call half of it salary and half of it income. Now, what do I mean by that? Well, if you set up an S corporation, let's say your name is Matt Langen, and you set up an S corporation called Matt Sells Houses, LLC. Well, when you do that, Matt is no longer, by setting up an S corporation, he's no longer self-employed. Technically, he is an employee of his own S corporation. The S corporation will report his salary to Matt of $40,000. And then the net income to the business after it pays all of its expenses, including the salary to Matt, is $40,000. Now, why is this important? Because we just took $40,000 off the table as far as self-employment tax goes. Matt will still pay some Social Security and Medicare through his payroll taxes on his salary, but we just basically split his income in two and took self-employment tax away from 40 grand. By the way, what is the savings on 40 grand? Well, 15% is 6 grand, but the way it works out with the IRS, there's a different formula they use. It comes down to $5,184. So that's a $5,000 tax savings just by having the right entity structure. Now, this may generate a lot of questions. Maybe we can answer those at the end of the session. You may already be an LLC, for example, and you can elect S Corp status, and that can change your taxes dramatically. So we can address that later, but this is a big deal. And if you were afraid of getting audited, look what happens to the audit risk for an S corporation. It goes from like 1 in 100 down to about 1 in 225. So it really lowers your audit risk. So we've talked about 3 things you can do. Number 1, plan. Number 2, don't fear the IRS, just respect them. Don't be so afraid of the audit. 3, have the right entity structure. Number 4, the mistake agents make is they have the wrong retirement plan. Now, most agents, if they're thinking about retirement, might start to think about an IRA. And what can you set aside in an IRA? 5 grand, 6 grand, that's it. it'll reduce your taxes, but it's limited. So if you make 150 grand, maybe you've got the cash, you could actually put more into a retirement plan and thereby reduce your taxes this year. I'll give you an example. Here we go. A SEP plan, SEP, called a Simplified Employee Pension Plan. This is nothing more than like a supercharged IRA. And you can take 25% of your income and put it into a SEP plan. So if you're sole proprietor, let's say you've got 80 grand in net income, you can put 20,000 of that into a SEP plan, reduce your taxes by 20,000 taxable. What does that mean? It means you save 22% on that money. That's about a $5,000 tax savings, right? You can do up to 58 grand. There's another one called a simple IRA. Now, I don't know if any of you may have like a side hustle going on, like many agents are full-time agents, but they do flips on the side, or they do staging on the side, or they do social media.
Realtors, Jim, everybody's got a side hustle.
they're like firemen. I've never met a fireman who wasn't also a landscaper half the week. Yeah, everybody's got a side hustle. Why do I mention it? Because in a simple IRA, you can take 100% of your earnings and put it into a retirement account from your side hustle. So if you got a side hustle doing staging, set that up as a separate business. Maybe you make 10, 15, 20 grand. You can put up to 13.5 of that into a retirement account. So it's good for a side hustle. By the way, I have a side hustle too. I help people who get into tax trouble save their, you know what, from IRS trouble. That's a side hustle. Okay, 401ks. Here's another one. Now this costs a little more to run. The first two examples, there was no cost. A 401k or a solo K, you'll pay an administrative fee every year to run this, but it gives you more options. You can set more aside. Also, you can take loans against a 401k. And why does that matter? It matters because when you're out in the market and you see a great opportunity to flip something, you might need some cash to do the deal. You can withdraw cash out of a 401k as a loan and not trigger a taxable event, and then pay the loan back when the flip has sold and you've made your gain. So anyway, number 5, the 5th mistake agents make is they don't hire family members in their business. I'll give you an example. Don't know how many of you have children at home, 7 years of age and older, but the tax courts have actually ruled you can employ a child 7 years of age and older in your business. Now, what can a 7-year-old do in your business? Oh, they can sweep the floors. They can put postage on letters. Heck, they can run your social media, your WhatsApp or your Snapchat account better than you can. So they can be your social media manager. Just kidding. But here's why this is a benefit. If you make 80 grand in real estate, and let's say you've got a 7-year-old, maybe just you pay them, I don't know, $10 an hour for 5 hours a week. It's not a whole lot because they really can't work a lot. But won't that up to 2,500 or 5 grand over the year? That 5 grand comes off of your income as a deductible expense. It goes on to the income of your 7-year-old. But the first $12,550 that child earns is free of tax. And the next $9,950 that child earns is only at 10% tax. Now, if you're in the 22 plus 15% bracket and your child's in the 0% bracket or even the 10% bracket, you're moving money downstream when it comes to taxes. So this is a way you can really generate some tax savings. Not to mention the fact, put it to you this way, your child goes to camp during the summer. You can either make the commissions, pay the tax, and then take the after-tax money and pay the camp fee, or you can employ your child in your business, write them a check, put it in their custodial account, and when the time comes to write the summer camp check, just write it out of the child's custodial account. You've basically just found a way to deduct summer camp, or to put it another way, use pre-tax money to pay for summer camp or YMCA fees or what have you for the child. So there's a lot that can be done. Now you really need to follow the law here. Write a job description, keep a timesheet, write an actual check and deposit it into the kids' accounts. Okay. Don't shortchange this. Many people see this and they think, oh, I can hire my kid. They start, slipping them 50s or 100s every so often. And then they try to file a 1099 at the end of the year on the child. it all blows up because now the child has self-employment tax. They have to be an employee, a W-2 employee. But if you're a sole proprietor and you have a child under 18 years old, then you're not even going to have any employee taxes on them. So it really is, it's crazy not to take advantage of this strategy. Another one is missing medical expenses. Now, you may have caught when I first started the presentation, I said, if you didn't know that you can deduct your daughter's braces as a business expense, then it's too late to do this in April. But it's June. We can get ahead of this game. You can set up what's called a Section 105 plan. A Section 1, it's just a section of the IRS code. Section 105 code plan allows you to reimburse your employees for their medical expenses. Okay. So if you're a sole proprietor, maybe you hire your spouse in your business. Your spouse has medical bills. Your spouse can submit to you as an employee his or her medical bills. The business can reimburse those bills as a business expense. And oh, by the way, your spouse's children can also be covered by this plan. That tends to be your children. And your spouse's spouse can be covered under this plan. That tends to be you. So this turns into basically a household medical deduction plan. Because let's face it, you really, as taxpayers, we really can't deduct medical in all reality, unless we have about 40 to 50 grand of major medical costs a year. Our medical expense is never going to see the light of day on a tax return. You can only deduct it as an itemized deduction, and it has to be more than 7.5% of your adjusted gross. Most of us just don't qualify. But here's a way to do it. Set up a Section 105 plan in your business. Now, if you're a proprietorship, you can hire your spouse. If you're a partnership, you could also hire your spouse. If you're an S corporation, this doesn't really work as well as some other type of entity structures. If you're a C corporation, you can hire yourself. You're the employee. The company can reimburse your medical expenses.
Hey, Jim, I have a quick question on that.
Yep.
So what type of legwork's involved in setting up a Section 105 in this case? I mean, is this just what are the steps to take? Or maybe you can share that at the end, what they can do, because I know many of us would take advantage of that.
Absolutely. So again, it depends on your entity structure, but there's a Section 105, like a templated 3-page document that we can help you with just to set it up. Just
okay.
Set up a Section 105 plan. The employee signs it, goes in your company records. You've got all the documentation you need if the IRS ever comes looking. That's what it's all. It's
and can you confirm what age that starts at again?
Well, it's good for any employee in your business. So if it's a child, it can be 7 years old or older.
Okay.
But it can apply to your spouse, or even can apply to you if you're an employee of a C Corp, for example. Just
sure.
A lot of ways to go here. And this covers a lot of expenses that you can see on the screen.
Yeah.
If you don't qualify for a Section 105 plan, you still can have a health savings account. This can be a big deal, because if you have a high deductible health insurance plan, combined with that high deductible plan, you can start a health savings account where you can put money into the account. And it's like a medical IRA, if you will. You get a deduction for the money that goes in there. And then when the money goes out and is used for a medical expense, it's not a taxable event. So it's like using pre-tax money for medical. Okay, so we've talked about a bunch of things. Let's talk about one. I don't know how many of you here on the Zoom call actually deduct home office expenses, but it is a easy deduction to take that a lot of people do not take, because over the years, the financial press has had lots of articles about how home office expenses an audit risk. Well, that was true 8 to 10 years ago. It's not true today. Congress has relaxed the rules. They've even created a safe harbor method of taking the home office expense. In other words, they want you to take it if you just follow the rules. So, and here's the rules. You may have an office at Swell Realty. You may pay Matt for an office. I don't know how your company works. But if the principal place that you do business is at home, and if you have a space at that home that's set aside exclusively and regularly for your home office, for your work, meaning maybe you work at Swell 2 days a week, but you work from home 5 days a week. There's a space at home that is exclusively used for business. It's not the dining room table. You don't have to clear off your desk to serve dinner. It is just maybe it's a space in the dining room, but it's exclusively used for the business. That can be deducted. And those are the IRS rules, which I just kind of went over verbally. You can either take the number of rooms in your house. If you got a 10-room house and one room's the office, 10% of your whole space can be used as a deduction. Or you can use square footage, like take the square footage of your space. Like when I first started my accounting business in 2006, I had about a 50 square foot area in my then living room. And my wife said, gosh, you're just accumulating paperwork everywhere. I've got files in the closets. I've got tax returns on the couch. Can you just go and get an office? So, I moved into an office. But that first year I had a home office. That's all I used. And I took the square footage, and I didn't have to include common areas like stairways, hallways, that sort of thing in my calculation. So what this comes down to is you can basically deduct utilities, insurance, what you spend on office furniture. You can deduct your rent payments, or if you have a mortgage, part of your mortgage interest and taxes. That all can be deducted. A portion of that can be deducted. Your business use percentage can be deducted. And by the way, if you're operating from home, you can start tallying your auto mileage sooner, because if home is your main office, then as soon as you leave the driveway, you're using the auto for business if you're going to meet a client. Here's another big one, and man, is it true right now. Many agents take mileage as their auto deduction. In fact, it's usually something like this. Your CPA calls you on April 10th, says, hey, how many miles did you drive last year for business? And you say, hey, let me check my auto log. 10,523 miles. Then, he writes that down, and that's your deduction. That works well in some years. Certainly not recently. I'll tell you why. AAA does a cost survey every year. How much does it cost to operate your car? How much per mile is the operating cost on your vehicle? Even if you drive a medium-sized sedan, it's 58 cents a mile. If it's a SUV, it's 71 cents a mile. And these are based on $2.86 a gallon of gas. I mean, gas prices are at $4.50, $4.60, $4.70 now. So you can imagine how these operating costs are going up. But how much will the IRS pay you? Well, the IRS will pay you 58 cents a mile this year. 58 cents a mile. And the gas prices have doubled. They were paying 58 cents a mile, 2 years ago, 3 years ago. They're doing you no favors, folks. So you can either take the auto mileage rate of 58 cents a mile, or you can take actual expenses. Now, what does that mean? Gas, oil, insurance, registration, licensing, but most importantly, the depreciation of the vehicle. The average vehicle today is $38,000 to purchase. The IRS will allow you to write that off or depreciate it over 5 years. What's 5 divided into 38? Well, it's over $7,000 a year for depreciation before you get to the gas and the oil and the tires and the repairs and the registration and the insurance. So if you are driving a vehicle today that is, I would say, $40,000 or more in value, and you bought it within the last year or two, you really ought to sit down with your tax professional. And if you don't have one you trust, I'd be happy to do that with you and figure out what's the best way to maximize your auto deduction, because the IRS won't do it for you at 58 cents a mile. Number 9 is missing business meals. Now, let me take a step back. Most people don't want to take the actual auto expense because their record keeping has holes in it. Most people don't want to take business meals because their record keeping has holes in it. One way to fix that is to hire a bookkeeper, hire someone who can keep your records. So we provide that service. There's lots of good bookkeepers in town. I know if you're just starting out in business, you need to protect your money, and maybe you don't have the money to hire someone to do this work. But honestly, if you're making 100,000, 150 or more in real estate, set aside money, have someone else chase down these records, take care of the tax details, do the tax planning, do the bookkeeping, get it off your shoulders so you can do some deals and make some money. Do what you do best, outsource the rest. Missing business meals, again, comes down to record keeping. A lot of people just don't keep records, but here's what the IRS says. If you have a bona fide business discussion with a client, a prospect, a referral source, or a business colleague, you can deduct the business meal. Now, it's normally 50%. There should be a red X through that 50%. I guess the file got corrupted when I converted it to a Google Drive presentation form here. Right now, it's 100%. If you have meals at a restaurant and you're with a client, a prospect, even a coworker, the two of you can go out for lunch today, have a conversation, a bona fide business discussion about your marketing approach, about your listing presentation, about what you're doing currently to grow your business, about lead generation, anything that it relates. That is a deductible. It's a bona fide business conversation. It's a deduction. I don't know of any self-respecting real estate agent who should ever have to pay full price for a pumpkin spice latte. Just find someone to talk about real estate. Number 10 is missing tax coaching service. This goes back to what I said, number 1. There's 10 mistakes agents make. The number 1 is they just are not proactive. So what does it look like to be proactive? Well, being proactive means you're not being reactive. You're not waiting till after the ball drops in Times Square to think about taxes. You're having quarterly meetings with somebody. That somebody should be a tax professional like myself that you trust, that you know, and who likes working with real estate agents, which frankly, a lot of CPAs don't want to bother with because you're just a once a year client for them. For me, you're an all year client because I do tax planning. We sit down quarterly with clients. We project their taxes. We help them calculate what their estimated quarterly payment should be. We make plans to reduce their taxes so that you know what to do, when to do it, how to do it. And we'll do that in July, and we'll do that again in October, and we'll do that again at the first of the year, and we'll do that again at tax season. So we also will be happy to review your prior year returns, see if there's any missed opportunities or mistakes. That's what we do for tax planning, tax coaching. If you want to know more about that, you can certainly schedule a tax strategy meeting with me. That being said, there's some contact information on the screen. I'm sure there's some questions. And if there are, let's roll. Let's hit them.
Yeah, guys, go ahead and if you have questions, take yourself on mute. Feel free, or I know there's the messaging option too. So we'll leave it open. If you have questions, go ahead and ask Jim directly. Come on, who's gonna be the first?
Hey, Jim.
Yes.
Hey, this is Dr. Mary, Dr. Kraft, Mary, whatever. So the auto deduction, are you allowed to change that each year? Or I thought you had a whatever you pick, you have to keep the same every year, if that makes sense.
That's a great question, Dr. Whatever. The reality
It's Dr.
is,
Mary.
okay, Dr. Mary. Yeah, I'm teasing you. It's a great question. You can transition from, if you took mileage last year, you can transition to actual now. Once you transition to actual, you have to stay there. So
Okay, that's what I thought. Okay, all right, thank you.
And this same strategy applies, if you're out looking for a new car this year, right? A lot of people know you can buy a 6,000 pound SUV and deduct 25 grand or more this year. Well, does it make sense longer term? Are you going to, I was talking with someone last week. Yeah. Hey, I just bought an SUV. I'm going to sell it in about 2.5, 3 years. Doesn't make sense to take actual because you'll get that big 25,000 deduction this year, but you'll pay it back in 3 years because you're selling the car. So you have to keep a lot of different strategies in mind.
Awesome, thank you.
Hey, Jim, I got a question.
Go for it.
So on the business meals, I keep very good receipt keeping and whatnot. So when you say, deduct the meal, what record keeping would you say is required? Just a receipt that shows the meal and the attendees that attended?
Yeah. And one other thing, whatever was discussed. So for example,
Okay.
you meet him at lunch, Panera Bread gives you a receipt. It's got the date, it's got the place, it's got the dollar amount. The only two things you need to add is who was there and what was the business discussed. So
Perfect. Okay.
You put down Matt Langen, discuss listing strategies. Boom.
Perfect. Thanks so much.
Mm-hmm. And by the way, you only need to have receipts for what is $75 or more. That's the IRS rules, but I would encourage you to keep all receipts and to keep them, scan them in so that the ultraviolet light doesn't, disappear in 3 months. I would keep receipts. Okay. Bank statements, credit card statements do not suffice as documentation for a receipt for an expense. You could go to Office Max Office Depot, you could buy a flat screen TV for your family room and call it office supplies as far as the IRS is concerned. So they don't want to see the Office Depot or the Home Depot, credit card statement. They want to see the actual receipt that shows that, you bought office supplies.
So
Go ahead.
I have a question. How do we, like, I've been wanting to use you for a while. Just didn't have enough money, but I'm just going for the expense now. How do we like go about it? Like call you, send you an email and say, hey, this is me and this is what I'm trying to do. Bring my tax return from the last year. Like,
Sure.
I am not great with most record keeping. I'm gonna just be honest, because
That's okay. I mean, the reality is you didn't go into real estate to be a good record keeper, right?
not for that.
And frankly, I find it's pretty crazy because you guys help people make the biggest financial decisions of their lives, right? But behind the scenes, a lot of you are just not good when it comes to your own finances. It's okay. I mean, it's just, you do well at what you do and help get other people to help you with what you don't do well. So you can simply call me, 757-346-1040. Again, that's 346-1040. Or you can email me, jim@anchortaxrelief.com. We'll just set up a free, like a Zoom call, and we'll talk about like what you're doing, what we could be doing differently, what my fees are. And then, if everybody's in sync, then, we send you a client agreement and we get started.
Yeah, because I want to start, because I knew I can't just, pay my son without like the timesheet and this and that. And, I guess I wasn't aware of having to write the whole, what is jobs could be.
Job description, all that kind of stuff. Yeah, you want to cross the T's and dot the I's. And this is why it's good to have a professional. Let's face it.
That's exactly what I want to do. I want to like maximize, because I mean, I am good enough about stuff, but then I haven't taken any, business meal expensive because I just don't keep records. So
yeah, happy to help you with that,
Awesome.
and just give us a call, 346-1040. We'll set up a free
I
meeting.
got it all written down. Okay.
All right.
Just
All
wanted
right.
to make sure.
You guys, you're in real estate, you give professional services, right? You are paid for your expertise, your experience, your know-how, your negotiating skills, and yet you still see people go out and for sale by owner. And it's like, now that you've been in this business, what a mistake that can be. The same applies to taxes. I mean, you could do it yourself, right? You guys are bright, you guys are sharp, but there probably are so many things you're missing just by not knowing what you don't know. I had a conversation with an agent about, it was right at the beginning of tax season, and this was a brand new agent. He called in, I don't know what company he worked for, and he'd only done like about 10,000, maybe 2 deals his first year, which is fine. Your first years, can be tough. And he said, so what do you charge, to prepare a tax return? I said, well, the average nationwide is probably about $500 to have a tax return done for a business owner like yourself. He said, that'd be 5% of my income. He said, you mean you would expect me to pay you 5% of my income to do my taxes? And my response was, and how much do you charge to help people sell their home? 6%. If you can't justify the 6%, that's probably why you only did 2 deals last year. You just really have to put a value on professional services, right? I'm not saying, hey, pay through the nose and pay someone who's not going to be responsive and isn't going to save you money on taxes. But, if you can find someone to help you, a few $100s a year is well worth it, because it's typically going to save you thousands. So anyway, off my soapbox. Any other questions?
I'm just saying that because I use TurboTax.
Yeah.
I still, like, the IRS still found some mistakes on it, so
Right.
It took me, like, I put all my taxes together in February. I didn't get it until just like last month. So because it was this crazy, and I was like, TurboTax wasn't cheap either,
No.
I mean, it was close to 500. I was like, no, I can use a real person that
Right.
can probably save me more money. So.
Well, we're glad to help you. I wanted to segue to one other thing, if I could, and that is, earlier I'd mentioned LLCs as a entity structure that wasn't listed. And I'm guessing there are several of you who have created LLCs somewhere along the way. And I just wanted to circle back on that because just so you're aware, an LLC itself does not give you any special tax advantages. It's great from a legal liability, limitation standpoint, but there's no tax benefit. Where the tax benefit of an LLC starts to come into play is if the LLC elects to file as an S corp. The good news for any of you who are an LLC is if you have that breakthrough year this year, you can choose to file as an S corp pretty much at any time through the year, because you were probably an LLC back when the year started. And so all of the income you earned as an LLC could be taking advantage of the S corporation tax rules. So I just wanted to throw that out there as a timing strategy for folks who may not be aware of it, or who may have created LLCs. And if you have any follow-up questions to that, I'm happy to answer.
Do you help with that, like with the creating of the LLC S corp or things like that, or?
We do.
Okay.
We can create the LLC. I could get a LLC or an S corporation set up for you today. I mean, it's a pretty simple process, and yep, we can help you with that. So pretty much anything that a real estate agent would need help with, we're designed here. And you can see I'm sitting in an office. I have the door closed, but we've got a staff of 5, and we're small enough to be personable, large enough to get it done. We can do your payroll. We do payroll service for a lot of agents in town, probably close to 100 agents. We do payroll service. They're on S corp setup. They have to have a payroll because they are now an S corp employee. We do the payroll. We do bookkeeping for a lot of real estate agents and brokers, not only here in the Hampton Roads area, but up and down the East Coast, because people see me on YouTube. Obviously, we do tax prep, we do tax planning, and we do tax problem resolution too. So we've got agents who unfortunately haven't filed for a few years and accumulate big tax debts, and we help to get those returns prepared and try to get the settlement down to an acceptable level so they don't, just choke paying taxes the rest of their life.
Wow.
Any other questions, anybody?
All right, it's Dr. Mary again. I guess I'll ask more questions. So I do have an S corp.
Okay.
I take advantage of most of everything you said.
Good.
However, my husband, he's my accounting, and he's super, I don't have time for it, and he's wonderful. But bottom line is, I know you mentioned hiring as an employee, and he's joked about me doing that. However, he makes a lot of money. He's a commander in the military. So is it even worth hiring him? Will it still help not me, but my company? Because I know it's not me, it's my company.
So the possible benefits don't exist in your case, doctor. The possible benefits of hiring someone would be, one, if that is a family member, is one, they're in a lower tax bracket, so you can move the money down to a lower tax bracket. Or two, there's no health insurance in the employment situation, which if he's a commanding officer or whatever, he's got health insurance already.
Right. Yeah, we
So-
both do. I'm retired military. He's in the military. So I
Yeah.
understand the health part, but I wasn't sure, does it even make sense to, I'm going to have to call you.
Yeah.
I use somebody, but I don't know if I'm going to use them anymore. So I'll have to call you. That's all I got.
Happy to help. I mean, generally though, you hire family members, one, to shift the income to a lower bracket, or to somehow implement a favorable health insurance situation. And that Section 105 plan that I mentioned earlier does not apply, for example, if your spouse is, military or military retiree and is covered by a plan. So, these strategies are kind of, if you will, global strategies, right? But they only should be implemented given your individual circumstances. That's why we don't really give tax advice in a Zoom call, right? We're just giving you some
Right.
general strategies and ideas, but we can't give advice because we don't, it all comes down to your particular individual situation.
But with the tax bracket, and I understand the health part, so I'm taking that one out, but just tax. As you know, you make so much money and then you get to a different tax bracket, and that's where your percentage goes up. Like you were saying earlier, it's not the whole amount, it's the difference. So
Right.
would it be advantageous to do that just for like the beginning of the tax? Because then we would still save on my side as the business, or like I said, I guess I'll call you. Because I
Yeah.
don't want to look up the whole Zoom.
No, that's fine. They're good questions. And I think in that case, you really kind of have a wash, because maybe it's a deduction to the business, but
Mhm.
he's also a family member who then earns that income, so that the money just shows up anyway as W-2 income instead of businesses.
Right. Okay, that's kind of what I thought. All right, thank you. And then lastly, I know you mentioned S Corp, which obviously, well, not obviously, that's what I have. But you mentioned C Corp and all that. Is one better than the other?
Comes down to your individual situation. The beauty of an S Corp is that your income is taxed, basically taking into account several things, right? Itemized deductions, business deductions, family tax credits, that all can reduce your tax. Whereas if you're a C Corp, you're going to be taxed at a flat rate of like 21% right now, period. Which may be good for you, may not be good. S Corp generally just gives you a lot more flexibility. This is the best way to put it.
All right, cool. Thank you.
Mhm. All right. Anybody have questions on auto? Anybody have questions on buying equipment, or is everybody just looking to get their next listing and let's stop talking about taxes?
Hey, this is
Yes.
Sean. I have one more question.
Sure.
I'm new. I haven't had any sales yet or anything, but if I wanted to set up an S Corp or one of those, what would be the best way to go about doing that? Or I probably want to just meet with you and get with you and set up a plan and do the quarterly thing. Cause I agree. If you spend a few bucks now and proactively, then you're going to save tons later. So.
Yeah, I mean, happy to sit down with you on Zoom or phone or whatever. 346-1040 is the number. Probably in your case, Sean, I'll just say though, for the benefit of everybody here, if a lot of times on these calls, we get the newer agents as a heavy percentage because, they're just wanting to learn. Whereas some of the older agents are like, oh, I know all that stuff. Newer agents, it's probably best not to start as an S Corp, but actually to start out as an LLC. Why?
Okay.
Because and I can help you with that. I can do that, but go the LLC route because one, it gives you immediate legal protection, but two, it draws a line in the sand. Without committing yourself to filing an S Corp return, you at least are an LLC. And one or two things are going to happen this year, Sean. You're going to blow it through the roof and make a lot of money, in which case you're going to want to file an S Corp return. Or you're just, you're not going to get what you had hoped. And if you don't get what you had hoped, there's no need to pay for an S Corp tax return or pay for payroll service when you're really starting out and you need to kind of run your business lean and mean. But at least set up the LLC. You don't obligate yourself to any additional expenses later, but you've got yourself, again, that line in the sand where you say this day, June 6, 2022, and from this day forward, anything I earn, I could elect to take advantage of S Corporation rules if I decide to do that later this year or next year or even the following year. I've had a lot. Here's an example. I had an agent. It was been about 8 or 9 years ago. I was in an old office, had just started out, and he was a Keller Williams agent. And I don't remember his name. I don't even think he's in the business anymore. And he came and met with me because he had just done his tax return, and he had done $148,000 his first full year in real estate. And his tax liability on the 1040 return he had filed was 48 grand, and he didn't have any of that in the bank. And so I told him, did you set up an LLC? No, I haven't done anything. I said, well, if you had filed as an LLC, and then we could, I would have known this, back before April, we could have prepared a return for you where you would have saved at least 10 grand in tax, at least, just by having the LLC set up. And then as the year comes to a close, you see her really knocking it out of the park, elect the S Corp tax treatment, and you would have saved, you'd be at 38 grand owed, which is a hell of a lot, but at least not 48.
Awesome. Perfect. Yeah. I'll be getting in touch to set up that meeting here soon.
All right. Okay. Well, guys, I trust this has been helpful. There's a lot of good nuggets in here. If you, again, want to download the presentation, I think the bit.ly link was bit.ly/realtors tax secrets. If you want to meet with me, I will be glad to have a free tax strategy meeting with you, typically by Zoom. And we can at least talk. There's no charge to you, and we can at least talk about where you're at, where you've been, and what maybe you'd like to be getting that you're not getting, and see if it's something we can provide and if it's a good fit. Because really it comes down to fit. Honestly, there's several good CPAs, enrolled agents, tax preparers in town who could help you. It's just who do you, who you're comfortable with, who speaks your language, who gets it. And that's really who you want to be with. So I'm happy to talk with you, see if we can be that person. All right. Matt, are you still on? Apparently not.
Hey, thanks a lot, Jim.
Okay.
Yep, there I am. I'm sorry.
Not a problem.
Yeah, thanks again for your time, and I'll make sure we pass your info to everyone in our Facebook group, so everybody's got your contact info.
Perfect. All right.
All right, thank you,
very
sir.
much. Okay, guys,
Alrighty.
great day.
All right, bye-bye.
Bye.